What really happens before a market crash? What is it that triggers a downturn that goes beyond just a bubble bursting and into a full-on generation-defining financial downturn? Think about 2008, when mortgage-backed securities fueled the biggest housing bubble in history. When it burst, U.S. home prices fell by as much as 40% in some markets, and millions of families lost their homes. Or go back to the Great Depression, when the stock market collapse left 1 in 4 Americans out of work and bread lines stretched around city blocks. These events felt sudden at the time, but here's the truth. They weren't. Crashes don't just come out of nowhere. The fear of waking up to see your savings wiped out overnight is real, but history shows us there are always signals flashing before the crash. And if you know what to look for, you don't have to be caught off guard. That's what this video is about, because when you trace the biggest financial collapses in history, you see the same 4 patterns appear again and again. The names and numbers change, the technologies change, but the psychology? That hasn't changed in over 500 years. In the next few minutes, I'll walk through 4 of the biggest crashes of the past 3 centuries. Each has its own strange story, but beyond the stories, you'll notice the same 4 signals. And here's why this matters. Those same 4 signals are flashing again today. Ray Dalio has been warning about them. Trump's current policies are accelerating some of them. And if history is any guide, ignoring these signs could be one of the costliest mistakes an investor can make. To see the first clear signs of what always happens before a crash, we need to step back in time, all the way to the early 1800s. Or actually, even earlier, to the early 1700s, because in the year 1720, Europe witnessed not 1, but 2 spectacular financial meltdowns, France's Mississippi bubble and Britain's South Sea bubble. They happened almost at the same time, and both showed the first 2 patterns that always appear before a crash: fantasy pricing and paper riches. Let's start in France. The country was drowning in debt after decades of war. Then came a Scottish banker named John Law, who convinced the French government to try something revolutionary. Instead of relying only on gold and silver coins, he would issue paper money through a national bank. Paper was lighter, easier to print, and could expand the economy much faster. But Law didn't stop there. He also created the Mississippi Company, which was given a monopoly over trade and development in France's massive New World territory, Louisiana. Now, when you hear Louisiana, don't picture the U.S. state we know today. Back then, Louisiana was enormous. It stretched from the Gulf of Mexico all the way up the Mississippi River, covering land that today would include multiple American states. To French investors in Paris, it sounded like an empire waiting to be unlocked. Law and his promoters painted Louisiana as a kind of promised land. They claimed it had fertile farmland, silver and gold mines, and booming trade opportunities. The story spread like wildfire. But here's the catch. Almost no one in France had ever been there. People had no way to fact-check the promises. All they had was John Law's story, backed by the French crown. It was a perfect setup for speculation. Shares of the Mississippi Company soared. The national bank kept printing more paper money to fuel the buying frenzy, which meant prices climbed higher. People felt richer, and even more rushed in. At the peak, shares had increased more than 20 times their original value. That's putting in $100 and watching it turn into $2,000 in just months. But the reality in Louisiana was far less glamorous. It was sparsely populated, much of it swampy, difficult to farm, and there were no great gold or silver mines. The riches were mostly exaggerated rumors. Once investors realized the dream was overblown, confidence collapsed. Shares plummeted. Paper money lost credibility, and fortunes were wiped out almost overnight. John Law himself fled Paris. At the very same time, across the English Channel, Britain was experiencing its own bubble with the South Sea Company. This company had taken on a large portion of Britain's national debt and promised investors huge profits from trade with South America. The problem? Britain didn't actually have the trade rights it was advertising. But like Louisiana, the story was enough to ignite a frenzy. Shares of the South Sea Company soared from about £100 to over £1,000 in less than a year. In today's terms, that's like a stock going from $100 to $10,000 practically overnight, without any real profits behind it. Even Sir Isaac Newton, one of the smartest men in history, got caught up in the craze. He made money at first, sold his shares, and then, against his better judgment, jumped back in when the mania reached its peak. He ended up losing most of his fortune. Later, he famously said, "I can calculate the motions of heavenly bodies, but not the madness of people." When the South Sea bubble collapsed, countless investors across Britain were ruined. Parliament had to scramble to contain the fallout, and trust in the financial system was shattered. So, what do these twin bubbles show us? They show us the first two patterns that always happen before a crash. Number one, fantasy pricing. When people stop asking what something is actually worth and start buying only because they believe someone else will pay more tomorrow, the market becomes a casino. That's not investing. That's gambling with a thin layer of respectability. Number two, paper riches. When wealth is built on financial instruments, promises, or even money itself that isn't backed by real value, it creates a fragile system. It looks strong in the moment, but the second confidence breaks, it all unravels. 3 centuries later, these patterns feel strikingly familiar. Because if you look at today's markets, don't we see some of the same signs? Entire industries are valued at sky-high numbers without solid profits. Paper wealth in the form of easy credit, printed money, and assets that only exist in digital form. And that's the scary part. Human psychology hasn't changed since 1720. The same forces that drove farmers, merchants, and even Isaac Newton into bubbles are alive and well today. Which brings us to the next crash on our list, one that shows how dangerous it gets when not just individuals, but entire banks and governments overstretch themselves. If the bubbles of 1720 showed us how individuals can get swept up in fantasy, the Bearing Crisis of 1890 showed what happens when entire nations and the most powerful banks overstretch themselves. At the time, London was the financial capital of the world, and no institution was more prestigious than Barings Bank. Founded back in the 18th century, Barings had financed governments, funded wars, and helped build railways and canals across continents. It was called the Banker's Bank, trusted by kings and prime ministers. If you wanted credibility in global finance, you wanted Barings standing behind you. But in the 1880s, Barings made a fateful decision. It went all in on Argentina. Why Argentina? Because at the time, it looked like the next America. Buenos Aires, the capital of Argentina, was nicknamed the Paris of South America. Railways were expanding at lightning speed, carrying grain and beef from the fertile pampas to booming ports. European immigrants were arriving by the tens of thousands, bringing skills and capital. From London, Argentina looked unstoppable, a country destined to be one of the richest in the world. British investors were captivated by the story. Argentina's bonds and infrastructure projects were sold on the London Stock Exchange like hotcakes, and Barings was the main underwriter. The bank poured millions into Argentinian debt, encouraging others to do the same. For a while, it seemed brilliant. Money flowed, new rail lines stretched across the plains, agriculture exports soared, and confidence was sky high. But then reality struck. Argentina's growth had been financed largely by debt, and when political unrest broke out in Buenos Aires in the late 1880s, cracks began to show. Revenues didn't meet expectations. Investors began doubting. What if Argentina can't repay? By 1890, confidence collapsed. Argentina's economy contracted sharply, its currency fell, and its bonds plummeted in value. Barings, holding mountains of that debt, suddenly looked fragile. The shock in London was immediate. Newspapers warned of a looming financial disaster. Crowds lined up outside banks, credit markets froze, people began to question, if Barings falls, who's next? The panic spread beyond Argentina. Now it was about whether London's financial system itself could survive. Here's where things got dramatic. For the first time, the Bank of England stepped in as a true lender of last resort. Governor William Litterdale knew that if Barings collapsed, it could drag down the entire global financial system. So he organized a rescue package. A consortium of London's most powerful banks, including the Rothschilds, pledged about £17 million as a guarantee fund. The Bank of England added emergency liquidity to keep confidence afloat. It worked, just barely. Barings was saved, though its reputation was scarred. Investors lost heavily, and Argentina's boom turned into a bust that took years to recover. But the world learned a hard truth. Even the strongest institutions can collapse when they take on too much exposure to a single risky market. This is the third warning sign that always shows up before a crash. Over-leverage and sovereign exposure. When a financial system bets too heavily on one story, One country, one sector, one sure thing. It becomes fragile. Everything looks fine as long as confidence holds. But the moment doubt creeps in, the entire structure can unravel in days. Think about it in modern terms. Today, we see similar risks when global banks hold large exposures to fragile markets, from emerging market bonds to Chinese property giants like Evergrande. Billions into emerging market crypto projects, betting that digital states will be the future. It might look visionary on the way up, but one shock, a crash in value, a political crisis, a loss of confidence, and suddenly, the bank itself is at risk of collapse. That's exactly what happened in 1890. The rescue of Barings was a turning point. It proved that markets were already so interconnected that one nation's debt crisis could threaten the stability of the entire world economy. Sound familiar? It's the same kind of fragility we saw in the 2000s with subprime mortgages, and the same risks we see today when governments, banks, and investors stretch themselves too far. By the end of the 19th century, the lesson was clear. Speculation can ruin individuals, but over-leverage can bring entire nations and their financial systems to the brink. And yet, history repeated itself. Because less than a century later, in the 1970s, the global economy faced something new. It wasn't just speculation or over-leverage this time. It was a perfect storm of outside shocks, oil, currency, and politics colliding at once, and it led to one of the ugliest downturns of the 20th century. By the 1970s, the global economy had already survived centuries of speculation, over-leverage, and sovereign debt crises. But now, it faced something new, a combination of shocks that hit all at once. Instead of one bubble bursting, several forces collided, and the result was one of the ugliest market crashes of the 20th century. It started with money. For decades after World War II, the world had operated under the Bretton Woods system, where currencies were pegged to the US dollar and the dollar itself was backed by gold. This gave stability to global trade. But by the early 1970s, the system was under strain. America was running huge deficits to fund the Vietnam War and ambitious domestic programs. The country simply didn't have enough gold to back all the dollars in circulation. Finally, in August 1971, President Richard Nixon stunned the world. The United States would no longer convert dollars into gold. This Nixon shock ended the Bretton Woods system overnight and left global currencies floating freely for the first time in modern history. The foundation of world money had just shifted under everyone's feet. Then came energy. In October 1973, during the Yom Kippur War, Arab members of OPEC imposed an oil embargo against countries seen as supporting Israel. Practically overnight, oil prices quadrupled, jumping from about $3 a barrel to nearly $12. Gasoline lines snaked for miles, energy costs exploded, and industries built on cheap oil were suddenly crushed under soaring prices. The fallout in markets was brutal. From January 1973 to December 1974, the Dow Jones Industrial Average fell more than 40%, one of the steepest declines since the Great Depression. Globally, markets lost between 34 and 43% in nominal terms. In Britain, the crash was even more punishing, and many investors would wait over a decade before their portfolios recovered. This was the first modern example of what I call the macro shock vortex, when multiple external shocks collide with an already fragile system. First came monetary upheaval, then an energy crisis, then political instability, all feeding into one another. Each by itself might have been manageable, but together, they created a downward spiral. And the scary part? To people living through it, it didn't feel like a classic bubble. There wasn't a stock frenzy or South Sea shares or dot-com IPOs soaring. It felt like the system itself was betraying them. Prices were rising, jobs were disappearing, and investments were evaporating all at once. That made this crash especially painful because it shook confidence in both markets and governments. Think about it in today's terms. The US dollar is already under pressure as countries like China, Russia, and even some Middle Eastern allies explore trade outside of it. At the same time, global energy markets remain fragile. Supply cuts, sanctions, and conflicts have sent oil prices swinging violently. And with wars and rising geopolitical tensions disrupting global trade routes, the setup looks eerily familiar. That combination of monetary strain, energy shock, and political instability is exactly what made 1973 and 1974 so devastating. By the end of 1974, investors were exhausted. Many believed markets might never recover. But of course, they did, though it took years. And when they finally did recover, optimism returned, technology advanced, and a new century arrived. But as history would soon show, optimism has a way of turning into euphoria. And euphoria, once again, set the stage for another spectacular collapse. Because in the late 1990s and early 2000s, a new kind of mania swept the world: the internet boom. And just like the bubbles of the past, it was driven by the belief that this time is different. Spoiler, it wasn't. By the late 1990s, optimism was everywhere. The Cold War was over, technology was racing forward, and the internet was starting to shape everyday life. Investors, analysts, and ordinary people all believed we were entering a new economy, where the old financial rules no longer applied. That belief set the stage for one of the most famous crashes of modern times: the dot-com bubble. The internet was exploding in popularity. Everyone knew it was going to change the world, but no one knew exactly how. That uncertainty created a perfect breeding ground for speculation. Suddenly, any company with a .com in its name could raise millions of dollars overnight. Startups with no profits, sometimes not even a real product, were being valued in the billions. Cultural signs of the mania were everywhere. Startups with no profits were buying Super Bowl ads. Pets.com, with its sock puppet mascot, became famous as the ultimate example. Huge advertising spend, little revenue, and no path to profit, but investors still piled in. Financial magazines ran covers declaring the new economy, and analysts on TV said profits no longer mattered. What mattered were clicks, eyeballs, and traffic. Initial public offerings, or IPOs, became the hottest ticket in town. Ordinary investors were scrambling to get in on them. People weren't asking, "Is this business profitable?" They were asking, "How fast can I flip this stock to someone else?" This is the return of our first pattern: fantasy pricing. Companies were being priced not on what they were actually worth, but on the dream of what they might become. It was the same psychology that drives every bubble. Investors piling in not for what something is worth, but for the chance to flip it for more. But there was a twist. This time, the hype wasn't just about speculation. It was also about technology itself. Investors believed that because the internet was so revolutionary, the old financial rules didn't matter anymore. Things like profits, business models, or balance sheets were seen as old-fashioned. What mattered was growth, clicks, and eyeballs. That's the fourth sign we see before every crash: technological hubris, the belief that new technology makes the old rules obsolete. For a while it worked. The NASDAQ index, packed with technology stocks, soared by more than 300% between 1995 and 2000. Companies with barely any revenue were advertising during the Super Bowl. Venture capitalists were throwing money at anything with an internet connection. But just like every bubble before, the numbers didn't add up. As soon as a few high-profile companies failed to deliver profits, investors started asking hard questions. Confidence cracked, and when it did, the entire market collapsed. From the peak in March 2000 to the bottom in late 2002, the NASDAQ fell by nearly 80%. Trillions of dollars in paper wealth disappeared. Retirement accounts were gutted. And people everywhere asked the same question: how did we not see this coming? The answer is that the patterns were all there. Fantasy pricing, check. Paper riches, in the form of stock options and inflated valuations, check. Overconfidence in a single sector, check. And above all, the dangerous assumption that this time is different because of new technology. The dot-com crash didn't mean the internet was worthless, far from it. The internet did change the world. Companies like Amazon, Google, and eBay survived and thrived. But investors who thought every internet company would win learned a painful lesson. And that's the thing about bubbles. They're built on something real, but they exaggerate it to the point of collapse. The internet was real, but the hype around it was unsustainable. Just like oil was real in the 1970s, just like trade was real in 1720, and just like Argentina's growth was real in 1890. The underlying story makes sense, it's the pricing that doesn't. So, by the early 2000s, the world had been reminded once again: Technology doesn't erase the laws of economics. And as we'll see next, the patterns that appeared in the dot-com bubble and in every crash before it are flashing again today. Ray Dalio has been warning about them, and Trump's current policies may be accelerating them. So we've seen it again and again. From the twin bubbles of 1720, to the bearing crisis of 1890, to the oil and currency chaos of the 1970s, and the internet mania of the 2000s. The details change, but the patterns don't. And here's the part that should make you sit up. Those same patterns are flashing today. Ray Dalio, founder of Bridgewater Associates, has long warned that we're nearing the end of a long-term debt cycle, one where skyrocketing debt, speculative excess, and geopolitical tensions set the stage for crises. In his latest book, How Countries Go Broke, The Big Cycle, he warns that nations with sustained high deficits, like the US, several G7 countries, and China, are dangerously close to structural collapse unless fiscal discipline returns. His prescription? Reduce deficits to about 3% of GDP to avoid a debt spiral. As Dalio puts it in his principles, if you worry, you don't have to worry. And if you don't worry, you need to worry. So, let's match today's world with the 4 patterns. Fantasy pricing? Absolutely. Valuations in parts of the market have taken on a life of their own. Companies trading at sky-high multiples, speculative assets with no clear use cases, and meme stocks pumped up by online hype. This is fantasy pricing in real time. Just like in past manias, people are buying not because of what something is worth, but because they believe someone else will pay more tomorrow. At the same time, we're surrounded by paper riches. Since 2008, central banks have created trillions of dollars and governments have layered on massive deficits. That flood of easy money inflated asset prices everywhere, from stocks to bonds to real estate. It feels solid while confidence holds. But as John Law discovered 3 centuries ago, paper wealth can vanish overnight when trust breaks down. Then there's over-leverage and sovereign exposure. Banks, pension funds, and governments are sitting on mountains of obligations tied to risky bets, from fragile emerging markets to Chinese property giants. Like Barings in 1890, today's financial system is stretched into areas it assumes will always deliver. But history tells us those assumptions are exactly what make the system fragile. And layered over all of it is the macro shock vortex. Energy disruptions, geopolitical conflict, rising interest rates, inflation pressures, and supply chain fractures are all colliding at the same time. It's the 1970s replayed with far higher stakes. Nuclear powers, instant global capital flows, and a trading system far more interdependent and fragile than anything investors back then could have imagined. When you put it all together, the picture is clear. The same 4 forces that showed up before every historic crash are alive right now, only larger and more global than ever. Now, where does Trump fit into all this? His policies have magnified several of these patterns. Trade wars and tariffs have introduced uncertainty into global supply chains. Massive fiscal spending has added to already historic levels of national debt. Deregulation in certain sectors has created pockets of speculative frenzy, while his tough stance on international relations has fueled geopolitical tension. Whether you support him or not, the reality is that these policies intersect directly with the warning signs we've just covered. When governments spend more than they bring in, when they add pressure to global trade, and when they encourage speculation through deregulation, it doesn't create the crash by itself, but it makes the system more fragile, more exposed, and more vulnerable to shocks. That's the dangerous combination, the patterns of the past repeating themselves under today's circumstances. So the question isn't whether another crash will come. History guarantees that one will. The question is whether you'll recognize the signs in time to prepare. Trump's adding trillions to the national debt, but could it be a planned market crash? Click the video on screen to find out.